Intel just reported Q4 and full year 2021 earnings, and as a result, the stock dropped several percentage points. We will take the latest numbers and model Intel growth in the next 10 years to derive whether Intel is cheap or an expensive investment at today's price. Welcome back to the Modern Investing channel, and let's dive into it. Intel is a semiconductor giant with a low PE ratio as well as a good amount of drama around its business. Intel is a turnaround story. Will Intel demonstrate to be a good value stock, or is it a value trap? And will AMD, Nvidia, and other competitors eat their lunch? These are some of the many of the questions that investors are asking themselves around Intel. In this video, we will dive into the fundamentals of the business and address each of them. Intel is a semiconductor company giving exposure to the tech growth megatrend. There is no doubt that the world is going through the digitalization of everything, and companies like Intel are supposed to be in the right place at the right time to capitalize on this growth. To give some numbers, the semiconductor market is expected to double to 1 trillion by 2030. What makes Intel attractive is its muscles in terms of technical and financial resources to win in a market that is increasingly leading edge and challenged by the extreme physics of semiconductors. Intel business encompasses the design of chips as well as the manufacture of them. To be precise though, not all Intel's chips are manufactured in-house. Some are delegated to third parties. They have 10 manufacturing sites spread around the world, and this sets them apart from AMD and Apple, for example, which fully outsource the manufacturing from third parties. Intel vision has been to become an XPU company. Therefore, they produce also GPUs and IPUs. Last year, they appointed Patrick Gelsinger to be CEO. Patrick began his career at Intel and spent 30 years there. Will he be the right person to turn around the business and start regaining market share lost from AMD and Taiwan Semiconductor in the last years? Time will tell. But before we go into the news cycles and drama, let's have a look at the business. The client computing group is the personal computer side of the business, and it is the thickest slice of Intel's revenue pie, counting for 53% of the revenues. The data center group counts for 36% of Intel's revenues and comprise platforms and related products designed for cloud, enterprise, and communication infrastructure. The Internet of Things products account for 6% of the revenues, and the programmable solution group account for 3% of the revenues. These are field programmable gate arrays and ASICs. And finally, the mobile eye part of the business accounts for 2% of the revenues, which focus on the development of computer vision and machine learning based sensing for applications like autonomous driving. There is actually quite a lot of hype around mobile eye, as the market for automotive silicon is expected to more than double by the end of the decade, and Mobileye announced that they will begin offering driverless robotaxis services starting this year in collaboration with Sixt. Last December, Intel management team announced that they are going to take Mobileye public, retaining a controlling stake in it and selling the rest. In this way, they are planning to raise capital for reinvestment in their core business that, as we will see later, has been struggling lately. But as you can see, Intel has a foot in essentially all aspects of semiconductor design, as well as manufacturing capabilities of its own. In my mind, this is an attractive perk of Intel because it gives it autonomy. Manufacturing chips in-house removes the risk associated with the semiconductor supply chain, and on the other hand, designing chips themselves fuels demand for their manufacturing capabilities, and therefore their factories are not going to run out of orders. The risk, though, is to become a jack of all trades and not specializing in anything. At least, this is the fear that many investors have and are skeptical for future growth. And here is where the drama starts. Some of Intel's customers have been moving away from Intel. Apple, for instance, has started designing its MacBook chips in-house, outsourcing the manufacturing to Taiwan Semiconductor. Microsoft has just hired an ex-Apple, ex-Intel engineer for speeding up design of in-house processors for servers running its cloud computing services and personal computers. The main reason is that Intel's main manufacturing competitor, Taiwan Semiconductor and Samsung, are a step in front of Intel in terms of manufacturing. Taiwan Semiconductor and Samsung can already now build chips with 5nm transistors, whereas Intel can only produce 10nm transistors. At the high level, the more transistors can fit in a certain amount of space, the more efficient the chip is. And this gives the 5nm technology of Taiwan Semiconductor and Samsung an advantage. Intel is far behind on it, and its 7nm production is expected to happen only in 2023. Though a tailwind for Intel not to be forgotten is its geographical footprint. Intel is a US company, and there is more and more political pressure to limit the dependence of semiconductor products from foreign markets. The US Parliament is working on the CHIPS Act, which would include some 50 plus billion in federal investments for domestic semiconductor research, design, and manufacturing provision, as well as it would involve tax credits. EU is thinking in similar ways, and they are working on the CHIPS Act on their own. When this will materialize, it would give Intel an advantage to expand its footprint at a competitive cost. Intel began investing heavily in new production capacity. It started a $20 billion investment in Arizona to build a high-tech factory that is expected to go live in 2024. Intel competitors, though, are not sleeping either, and Taiwan Semiconductor has raised its spending for 2022 to $40 billion after reporting record earnings. These huge investments are on the back of a worldwide chip shortage. Semiconductor delivery time increased by 6 days in December to 25.8 weeks, showing the strong demand in the sector and the lack of adequate manufacturing capacity. The strong demand is good news for every player in the sector. Taking a step back, in my opinion, there is too much noise in the space in trying to predict the next fastest chip and the next highest high-tech factory. While that of course is important, we must realize that the entire semiconductor space is in a massive secular trend that will lift all boats. At the moment, Intel is getting all the bad headlines and all the bad news. Making a great investment is not necessarily a game of buying the leading company at any valuation. It is a game of paying the right price for what you get. Value investing pays a lot of attention on the price at which we pay for a business. Making a quick comparison between Intel and some of its leading competitors, we can see right away that Intel is already priced to be the underdog. Both looking at price to earnings, forward price to earnings, price to book, and price to free cash flow, Intel is by far the cheapest. What I like about this is that this gives Intel as an investment an intrinsic margin of safety because it has limited downside but with the potential big upside in case it managed to turn around the story and regain its leading position. Let's now dive into Intel's numbers. Revenues increased steadily over the years from 52 billion in 2012 to 79 billion in 2021. That gives an annualized compounded growth rate of 4.3%. Gross margins, which are calculated by deducting the cost of manufacturing from the revenues expressed as a percentage, decreased over the years, from 60% plus to the mid 50%. This is not great to see. Ideally, you would like to have the manufacturing efficiency to increase and have economy of scale improvements. This is not the case, and the CEO communicated that in the next 2 to 3 years, gross margins will stay little above 50%, for then increasing after that. Net income jumped in the last 4 years, giving a compounded annualized growth rate of 6.8% in the last 10 years. Cash flows from operation increased in the same manner at 5.3%, although in a smoother way over the years. Capital expenditure, which is the cost of Intel to renew and expand its production, range from around 10 to 19 billion per year. This is of course a cost to the company, and the new CEO has committed to big spendings to put Intel back in its growth trajectory. That is because they are lagging behind on the manufacturing, and they will need to keep on spending to stay afloat. So I don't see it decreasing anytime soon. If anything, it will stay at the 20 billion per year and maybe even higher. Free cash flow, which is calculated by subtracting the capital expenditure cost from the cash flow from operation, grew in line with revenues at little above 4%. Notice, however, how it fell from a cliff in the past year due to the high capital expenditure. If we calculate the free cash flow margins, we can see that it ranged from a low of 14% this last year to a high of 27% in 2020. Book value per share, which is the sum of all assets minus liabilities, increased at a 9.4% pace over the years, indicating that the company is compounding value for its shareholders. Share outstandings have been decreasing over the years at 2.5% rate, thanks to buybacks which create value for the shareholders. Another way to reward shareholders is by stock dividends. Dividends have been increasing at a 2.9% rate over the years, and in 2021, Intel gave 2.8% dividend yield. Let's now predict how much cash will Intel generate in the future. For 2022 and 2023, I took analyst estimates of growth, contracting 7% in 2022 and then start growing again at 5% rate in 2023. We need to take into account that the whole semiconductor market is expected to grow at 8.6% per year from 2021 onwards. I think Intel will, however, underperform its competitors, so I expect that it will be able to expand its revenues by only 5% per year until 2026, for then increasing to 7% in the 5 subsequent years, after the new manufacturing plants that are now under construction will be fully up and running. This will generate the following amount of revenues, or 4.7% of compounded annualized growth rate. The free cash flow margins, I expect that they will stay at these 10 years low levels of 14% in the next 3 years due to the steep speed up in investments. After that, I expect that they will slowly creep up to 20% mark that has been the average for the past 10 years. This contraction in margins for the next years will of course play a big role in Intel valuation, but it is a necessary evil to get Intel to be competitive again in the long term. So these assumptions gives us the predicted future cash flow that you see here, which represent a 8.5% compounded annualized growth rate. Let's now take those values and make a discounted cash flow valuation to estimate the present intrinsic value of Intel. I took the previously calculated future cash flow values and pasted them in this row. Here we have the input values, the growth rate which we calculated to be 8.5%, the discount rate which is the weighted average cost of capital. You can see over here the calculation that led me to the weighted average cost of capital of 5.59%. Then we have the terminal multiple for calculating the terminal value. I chose the terminal multiple by looking at the historical price to free cash flow valuation of Intel from 2006 to today. We can see that the average for the period was 12.5, which is very close to what is trading today. So I chose 12.5 as the exit multiple. In this row, we have the future discounted cash flow values. If we sum them up, including the terminal value, we get this number that corrected by cash and liabilities and divided by the share outstanding gives us a fair present value of $40 per share. As of making this video, Intel is trading at 48 per share, which means that at the moment, Intel is about 20% overvalued as compared to where the stock should be trading at. In conclusion, I like that Intel is in an industry with strong secular tailwinds that, no matter how much drama we surround the business, will help Intel growth in the future. Between the digitalization of everything, 5G, artificial intelligence, and autonomous driving, Intel revenue pie should grow in the years to come. Furthermore, the fact that Intel is a US company is a big plus, and I expect that the homemade manufacturing of key products like semiconductors will become more of a topic of discussion by politicians for national security, and the US and EU Chips Act should move us in that direction. I like that Intel is a vertically integrated company where they do everything from the design to manufacturing. I think this gives them flexibility and allows them to not be affected by supply chain shortages. My discounted cash flow valuation gives Intel a fair price of $40 per share, so Intel valuation is stretched at the moment. But should the stock fall 20% or more from these levels, it would go potentially in buy territory. As compared to its competitors, Intel is priced to be a loser, and I like that because it gives it limited downside potential and a big upside potential if the story turns around. What I don't like is the fact that they are indeed the underdog right now. They are losing key customers like Apple and Microsoft. Their planned 7nm manufacturing plant cannot come soon enough. As per my situation, I own a small amount of Intel stock in my portfolio, but I cannot make it a big position until I see the business turnaround happening. Besides, the stock is overvalued in my opinion at the moment. So for now, I hold it as a small exposure to the semiconductor space. What do you think about investing in semiconductor companies? Is Intel a good buy or would you rather invest in Intel's competitors? Write down in the comments your opinion and see you in the next video. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.